Perfect. So thanks to everyone who's joining. Ali is a chartered professional accountant, and he's volunteered his time tonight to talk a little bit about taxes and real estate. And I appreciate you taking the time to do this. Um, a chartered professional accountant is different from an accountant in that they understand a lot more about the tax laws. And whenever you are making decisions in real estate, it's important to know what the implications will be in terms of taxation. So I'm going to let you take over, Ali.
Thank you, Negin. So, can everyone see my screen?
Yes.
Okay. So, I'm going to start and say that I'm a big believer of going to professionals for what they know for the things you need to do. So, your property is one of your biggest investments, one of your biggest assets. And when it comes to buying and selling those properties, you go to a professional real estate agent who knows the markets, who knows the best way to negotiate and buy and sell that property. Likewise, when it comes to the tax side of it, you want to have someone who understands the tax laws as much as possible because the consequences of that same big property and asset could be very severe. So I'm going to start talking about a little bit about the taxes that affect your property. And this is not going to be a numbers heavy session. I know tax is not exactly the most exciting thing in the world. So we're going to keep it at a level that when we when we're done, you'll leave informed and have a little better understanding about like how the Canadian taxes work in Canada. So before I go into any details, I have to always go over the disclaimer. These are general pieces. Do not take this as investment advice or as tax advice. Everyone's situation is different. So just keep that in mind with this. And we won't really go into anything that's too personal because, again, everyone's tax situations will be different. So the the agenda on this, I want to first talk about a little about myself so you can understand my background. So when I'm saying the things I'm going to go over, maybe you'll have a little more appreciation for it. And then I'm going to talk about three key parts: taxes and real estate transactions, going over tax compliance, land transfer tax, the things that happen in the transaction itself. Then I'll talk about some of the taxes in your investment property itself. And then finally, we'll talk about your principal residence and the tax implications for some of the things that happen there. I'll go a little bit about our company afterwards, and then I'll have some closing remarks for you all, and I'll leave it open for questions at the end as well. So please save your questions to the end. So a little bit about myself. Um, I'm a numbers guy. I'm an engineer turned accountant, so numbers has been in my blood from a very young age. I have 20 years of accounting experience and finance experience as well. And some of my past experiences, I was a risk manager at a boutique hedge fund uh, during the financial crisis of 2009. So that was fun. And I was a director of finance at a large corporation. I was also a senior manager at Deloitte, and I'm a small business owner. From terms of my education and background, well, I have my mechanical engineering degree from UFT. I have my MBA from Schuh School of Business. I am an accountant, so I have my CPA, and I have a finance prep designation, and I have a risk management designation as well. So let's get into the taxes itself and tax compliance in real estate. So why are we talking about taxes? Well, I think this is a very important piece that has really become the focus of the CRA over the past, let's say, from 2015. So the tables you see in front of you are actually directly from the CRA themselves, because this is one of their focus areas. So some food for thought, since 2015, the CRA has added a lot of resources. And in that time span, so this is from 2015 to 2023, so 8 years. In 8 years, they've done over 74,000 audits worth $2.7 billion in Ontario and BC alone. And that is their primary focus area because of the real estate prices in these two provinces. So the first table talks about the various things they do audits on. So we have your income tax, we have your GST, we have your new residential builds, and we have those across Ontario and BC. And I'll be talking about all these in our segment. The table, the graphs here show I want to show, it shows the pickup in the audit compliance that they've done. So you can see here, it started off slow and got more and more as time has gone up. So I don't see this trend going down anytime. And based on the results they're having, and you can see the penalties on the bottom table, because of the amount that they're finding, it's incentivizing them to look further and dig deeper and look at people's real estate even further. So this is why it's important to know the taxes and the implications and work with someone that can guide you through this. So the first tax I'm going to talk about is the land transfer tax in Ontario. One thing is that it's payable in every purchase. And just to give like a rule of thumb, if you have $1 million house or property, it's adding about 16,500 on top of that. So that's the cost gauge to look at it. And the table here, you'll see that as the property value goes up, the tax also goes up with it on the marginal tax rate. Toronto, feeling like they're very special, likes to have their own land transfer tax on top of it. And it's the same rate. So that same $1 million property, if you had it in Toronto, you'd be paying 33,000 in taxes, in the land transfer tax alone. There are rebates available for this, for first-time home buyers only. So Toronto has one and Ontario has one as well. The key part is that when they say first-time home buyers, there's different definitions going around between what the CRA considers first-time home buyers and what the land transfer tax defines as first-time home buyers. So I've listed out here for you, which is for land transfer taxes, you can never have owned a house anywhere in the world ever. That's their definition of a first-time home buyer. Whereas for CRA purposes, if you've never owned a home anywhere in the world in the past 4 years, then you're considered a first-time home buyer. So I think that's a very important distinction to know. And even if they use literally the same terminology, they don't mean the same thing. The last point on this I'm going to say is that there is partial refunds that are available if your spouse is like a non-resident, but these are special circumstances. And the refund is going to be based on your relative percentage for that rebate, the 4,000 in Ontario and the 4,500 in Toronto. The next tax in real estate transactions is HST on the purchase of your property. Most people don't know this, but the price that you actually see when you go to a builder and buying a property, that's already including the HST in the price. So 13% of the tax is really like on top of the price that you see. And it's for key parts that it's got to be new or substantially renovated property. And there is a rebate available again for the HST. You can get up to $24,000 of the PSD back in Ontario if it's your principal residence or if it's meant to be as an investment property, but that you're going to be renting it out for at least 12 months. The key part is that, and again, this is the distinction part. If it's your principal residence, builders have already included it in everything. So that's kind of like the price that you see is the price that you're going to get with the rebate included. But if you're an investor, they actually will add 24,000 to the price that you see because you have to pay for the tax up front and then ask for the rebate later. And you get that with like filing a rebate to the CRA. So if you looked at the compliance that we looked at the beginning, the rebate is one of the key areas of focus. So this rebate that you do, because you're asking the government for money back, they're always a lot more hesitant and want to see a lot more details when it comes to that. I'll briefly talk about GST. There is a $6,000 GST rebate available for properties less than 350,000, but it reduces to zero for properties above 450,000. So, and these numbers have not changed since they were introduced. So as a result, like the GST component doesn't really become a significant consideration if you're in Toronto or Ottawa. But that's something to consider. Next, I'll talk about the non-resident speculation tax. And I'll just say that the government really likes to put a lot of extra taxes on popular things that they think will give them votes. This one, I'd say, would be one of them. Um, Initially, when this was created or dreamed up, it was just for the greater Horseshoe area, which is basically the greater Toronto area and a little bit outside of that. But after that, it was expanded to include all of Ontario. So now, if you're a non-resident, you have to pay a 25% tax on the purchase price um, if you are non-resident. And this applies to all of Ontario. And there is an exemption. And just like as time has gone on, the exemptions have been reduced. So before, you could get the exemption um, as long as you had, like, if you're a spouse. But in terms of rebates, that has changed. So you can get you can get a rebate for the non-resident speculation tax if you became a permanent resident, if you were an international student enrolled in school, or if you were working here for at least a year. But since 2022, these two have been eliminated. So the only way you can get a rebate for the non-resident speculation tax is if you become a permanent resident. That's it. So you have 4 years from when you pay this tax, if you're a non-resident, to become a resident and ask for a rebate at that point. Now we're going to get into the investment properties. So in terms of rental income, there's two distinctions when it comes to this. There's short-term rentals and then there's long-term rentals. So with short-term rentals, it's got to be something that's less than 30 continuous days. And if it is that, the CRA could consider this to be more of business income than rental income. And that has implications because if it's business income, then if you have too much sales, you have to register for HST. And if you don't charge HST, the government will just take 13% from whatever you did get if you should have registered and consider that as the HST component. So if you do have rental properties that are short term and you're making more than 30,000 a year, it's very important that you consider this and you register for the HST if it applies to you. And there's a distinction here for non-residents. Non-residents must withhold 25% of the gross rent and pay that to CRA each month. There are options to change that to 25% of your net rent, but you have to elect with the CRA and the CRA has to approve it. The irony is that the CRA puts the onus of this on the person renting the property, not on the person owning the property. And goes the case for all of them because that for them, if you're a resident of Canada, if the person's renting it, more chance they're a resident of Canada, it's easier for them to go after them than as opposed to a non-resident. If you have longer term rentals, so this is anything for rental agreements over 30 consecutive days, this is considered passive income and it has a very different implication. So if it's passive income, no HST registration. And a non-resident, same as with the short-term one, non-resident must withhold 25% of the gross rent and pay the CRA each month. And there's an option to withhold 25% of the net rent. So now I'm going to talk about some common expenses and deductions you can have in your investment property. Generally, and this is not an exhaustive list, a lot of things are deductible if it's an investment property. So I've gone through some of the more popular ones. So starting from the common ones, we have accounting fees, property taxes, mortgage interest, insurance, condo fees, or any repairs you do. Travel is an important one. You can deduct travel expenses, but if for meals and lodging, that's considered personal. And for motor vehicle expenses, you are allowed to claim that if you have more than one rental property. Now, some of the things that you cannot claim, personal portion of your expenses. The government doesn't want to give you a deduction for something that's not involved in your business, and it's just for your personal purpose. Your principal payments for your mortgage are not deductible. capital expenditures are also non-deductible, and we'll get into this in the next slide. So capital expenditures are more like large scale expenses. So like replacing a roof, doing major renovations, things like that. Those would not be directly fully deductible right away. And finally, land costs. Land is not deductible. So that gets us into my most math heavy slide, which is this one. Um, I'm going to talk about depreciation capital gain. So if you recall in the earlier slide, I said that you can't deduct large scale things like renovations and roofs because those are considered capital. So what this share considers capital is basically they have created their own rates and you are allowed to deduct it, but only at the rate that they allow you to deduct it. So, and the CRA calls this capital cost allowance. So I'll give an example. So based on different types of assets, we have like appliances. So for example, the CRA has said that appliances can only be deducted 20% of its cost every year. So year one, you do 20% of that. Year two, you do another 20%, and so on. So if it costs you $5,000, you can only deduct $1,000 a year on your investment property. It's very important to keep track of your costs. And every dollar that you deduct on this, it's a dollar taken off your income for tax purposes. So this is where it becomes important to keep track of how much you've claimed as a deduction every year to how much the current balance is. So let's go back and let's say that we had something that we bought for $60,000. And this is my example right here that I'm going to talk about. So if we bought something for $60, that's my cost. And over the years, I was able to claim my capital cost allowance, and my unclaimed portion is now only $20. So if I sell this thing for $100, there's two different components that the government looks at. One part is what we call CCA recapture. So the government says, I gave you $40 off over those years. Since you sold this thing for over $100, for over the price you bought it for, I'm going to add all of that money right back to your income. So as a result, $40 of it will be recaptured. So it's going to add $40 right into your income for that year. Because this is how much they've deducted all those years from the 60 down to 20. The second component is now that you got to your original cost, anything above that is now your capital gain. So you sold it for $100. Well, it cost you 60 to get it. So now I'm going to have $40 go on your capital gain. So in this example, when you sold that asset that you bought for $60 for $100, the government considers that not $100, but $80. 40 from the recapture and 40 from the capital gain. So now that you survived my most math intensive slide, I'm going to talk about, and I think this is also a very important thing to consider. There is proposed changes to capital gains, and I think there's been in the news a lot about the changes, and it started around June. It became into effect June 24th, 2024. And what that rule, so I'm going to talk about the current rule, and then I'll go over the proposed changes. So in the current rule, it's very simple. Anytime you have gains, half of that is taxable, and the other half is tax-free. So this rule applies blanket across personal taxes, across corporate taxes, and across trusts. The new proposed changes, and it's not law yet, this is very important, it's not law yet, says that any capital gains after June 25th, 2024 will have this criteria. If it's personal taxes, the same 58% applies, but only for the first 250,000 of capital gains. Anything above that, 67% is going to be taxable, and only 33% will be tax-free. For corporations and trusts, it's even more strict. Any dollar a corporation or trust makes, even if it's a dollar, 67% is taxable, 33% is tax-free. And there are transition rules that would be applying because 2024 is a transition year. However, because it's proposal, we don't really have the full rules on this yet. So that brings up to my third point. Why am I bringing this up here? The key reason is that even though this is not law, the CRA is going to assume the new rules apply, even though they are not law. So you have an option at this point, what the CRA says. Because the new rules are not law, you technically they can't force you to use the higher capital gains tax rates. So if you give 50%, they will accept it. However, if this does become law later down the road, the CRA will come back and say, that time that you gave me only 50%, I'm going to now charge you backdated taxes because you should have given me 67%. So that's why it's very important. And this is going to be something you have to decide what your options are. So what the CRA is saying right now, even though they realize that it is not law, is to play it safe, apply the more strict rules. And if the new government or if the liberals become in power again and they choose not to pass this, then you can ask for a refund from the CRA, and the CRA will give you a refund with interest. So that's something to consider with these new rules. And this is a very controversial decision because most times, until it's law, they say you can't go on and do this. But the CRA has actually received support from the Department of Finance on this. So that's where we are at right now. So now we're going to get to the principal residence and taxes part. So so why does principal residence matter? Um, a principal residence is a home where you and your family regularly live. And this is a key part. The property can be anywhere in the world. It doesn't have to be just in Canada. And you can only designate one property per family or couple per tax year. So I don't think a lot of people know this, but the principal residence actually has a restriction on the land size that can be claimed as principal residence. And it's 1.24 acres. Now, if it doesn't mean that you can't have a property that's larger, but there has to be a justification, or you have to prove to the CRA that the larger land size is required for your personal use and enjoyment. So an example would be if you are in a rural property and the severance on those places is more than 1.24 acres, because it's regulated, then this year, then you're following the rules, and in which case it's fine. If like there is protected um, forest areas and whatnot in your property, that again falls into the spectrum that it's fine, that it's part of your enjoyment. But it's generally we don't get a lot of challenges on this, but again, it's something to consider. So you can't just go get the biggest property you can find and say the whole thing is principal residence. There's got to be some rules and regulations around it. Honestly, in my view, I think principal residence is like kind of the last biggest tax benefit Canada has compared to like the US. Because the why principal residence matters is that it's 100% tax free. So the entire gain you don't pay any taxes on. Even the US has limitations on it. But in order to be able to claim this as your principal residence, you can't claim any expenses for that home. So nothing's deductible. And if you have a loss on the sale of your principal residence, that is also not deductible. So you have a loss, then that's it. There's nothing to do about it. So now we're going to talk about a little bit about ancillary income in your principal residence. So you can rent out a portion of your principal residence and while maintaining your, we call it PRA for short, PRA status on the entire property. But there are certain conditions that apply to this. So obviously, you must include any rental income in your taxes. And the rental portion is supposed to be small compared to the rest of your home. What does that mean? That's a very good question. The CRA will never give you a straight answer. Um, all they say it's got to be small relative to it. And the reason why they don't give you like a number or something is because they don't want people to kind of come to that line and stay behind it. So they leave it open and ambiguous for explicitly for that reason. Ironically, if you want to have a principal residence exemption, it has to have minimal structural changes. So for example, if you have a basement unit, this part is key, and you add a separate entrance, or you make a kitchen in your basement unit because you want to rent it out. Technically speaking, by the book, it is no longer considered part of your principal residence exemption because you made a structural change, and the CRA would argue that you did it for the purpose of renting it out, which is to make income. So then that portion will not be part of your principal residence exemption. So I talk about the technical side of it. When it comes to the actual application, it's always a question of fact. So, but that's something to consider that whenever you're doing any of these, like a major change to your house or condo or property, if you do a big change, if you do a change to it, automatically you're in that category that technically you may not be able to. The CRA could argue that's not principal residence anymore. So what does that mean for you all? Is that if you are buying a property that already has a separate basement entrance, already has a kitchen in it, and you bought that property and then later on you decide to rent it out, that is perfectly fine because you did not make any changes to it. It came that way. So that third point here applies if you actively make a change to that property. And that's why I say, so that's why I'm saying that. And we get into the ancillary income. The income tax act doesn't actually have a definition for what ancillary income is. So again, it's open to interpretation and it's a question of facts and circumstances. But generally, the smaller the portion of your house that's used for rental income, the easier it is to argue a position that it is used, that your entire house should be used, should be protected with the principal residence exemption. A good way to think about this is I have a couple of clients before we work with them. They're a couple that they both had home offices, and each one was claiming 20% on their each respective tax returns, and they were refiling it that way for years. So when they first came to us, we always do a review of the tax returns that they had done before to understand the situation. And the first question I asked them was that, do you know that your 40%, you claim to the government that 40% of your property is business use? And excuse me, and they were a little bit surprised because I said, think about it. You're telling the government 40% of my house is for business. I'm going to write off expenses, but I want 100% to be tax free. So, sorry. So that's the thing you have to consider is that the higher that rate goes, the more in risk you are. Finally, you can't claim capital cost on that property. If you claim any capital cost allowances, you lose your entire principal residence exemption. All right. So now I want to talk about change in use. So this is going to get a little bit more wordy, but basically change in use is in your diagrams, in the two diagrams here. First change in use is if it goes from your principal residence to a rental property. So this can be a full or partial change in use. So for example, you can say, I just want to change my basement and keep the rest as my principal, or the whole I'm moving out and the whole place is becoming my rental property. Key part is that the principal residence exemption will shelter that change in use, and there'll be capital gains and loss after that change in use. Because at that point, it becomes a rental property. So from the government's perspective, it's an investment at that point. So from that point in time that you change the use until the day you sell it, that difference will be capital gains. So the next example is it the other way around. You can have a change in use where you go from a rental property back to your principal residence. When that happens, um, capital gains would be applied from the time that it was a rental property to the point that it became your principal residence again. So here's the part where you might be thinking, how can they do this? And the reason is that there's a clause in the Income Tax Act called deemed disposition or acquisition, which basically says that whenever there's a change in use, even if you actually did not get rid of the property, the CRA will consider you. So in the example of going from a principal residence to rental, the CRA will consider that you've actually sold that property at fair market value at that date and bought it back at fair market value. So that's why they call it deemed disposition, because even if you didn't sell your property, the CRA will still hold you liable for that change in use. And the CRA will assess capital gains from that point based on the fair market value accordingly. So this is one area that some people don't realize the implications for it. And when you do have the capital gains, especially when you go from a rental property back to your principal residence, there is capital gains implications at that point. So even though you didn't sell the property, you owe tax to the government, they will ask you to pay the capital gains for that at that point in time. And it's also important to note that when they say fair market value, it's not based on like a real estate agent assessment. It's based on an appraiser. They want to, like, that's an appraiser report is what they accept. So now that we talked about change in use, there's some good news. There are elections available to protect that change in use and the tax implications that come with it. The more popular one is the top one, which is going from a principal residence to rental property. We had a lot of these over the past couple of years because of the rise in interest rates, where people moved out of their house, rented it somewhere smaller, and rented their current house to make up the payments. So with a change in principal residence to rental property, you can make an election to the government where you can still keep it as your principal residence for up to 4 years from that point in time that you made your change in use. So, for example, if you were in your home and you decide to rent it out in the year 2023, if you make the election until the year of 2027, it still considers your principal residence, even though you're renting it out and you're not living it. So the good thing about this is it gives you options to go out, rent a place, see a place, and then if you see the design doesn't work out, you can go back to your rental property again, and it will not affect your status on your principal residence at all. But I think this is very important to consider is that you can't claim another property as your principal residence when you do this, because you're already telling the government, this is my principal residence. And excuse me, late filings are up to the discretion of the CRA to accept. So if you don't file it on time, they may not accept it. Whereas if you file on time, they have to accept it. Then we have the second condition, which is changing rental property in a principal residence. So going from rental property to a principal residence. You can make this election 4 years before the actual change in use happens. So same idea, but the other way around. So if you decide that in 2026 you want to go back into your current currently rented property. In 2023, you can tell the government, I'm going to make it my principal residence. So again, from that point on, you're sheltered and you get the benefits of any appreciation during these years. um, the election allows you to, so the other part with this second election is that it allows you to defer the capital gains. So if you recall, I said when you have a change in use from rental to principal, there's a deemed disposition, and that you have to pay capital gains tax on it. If you don't make this election, you would have to pay it at that point in time when you make that change in use. However, if you make this election also allows you to not to defer that capital gains tax until you actually sell that property. So it's very important to make sure that you work with someone that knows these rules very well because it has very heavy implications on your property. Now, some general notes about these. You can have an extension beyond the 4 years in special circumstances. So if you, for example, are working for a company that has sent you to another country and you're still working for this Canadian company, you're allowed to keep that principal residence for longer. And when in all these elections, you have to be a Canadian resident. Even like during when you're making the election and after as well. You have to be Canadian resident throughout the whole time. And finally, you can't claim any capital cost allowances on any of these properties. If you do, you cannot use these elections at all. So now we're going to talk about the underused housing tax. Again, this is one of those another popular political programs that was designed without any, I would say, research behind it. And the background, honestly, when this came out after Trudeau was reelected, the Liberal government was reelected, there was so little thought put behind this program that us as the tax practitioners had a very hard time getting guidance from the CRA about it. And it caused a lot in the first 2 years. It caused a lot of people that were caught in an unintended consequence. So, for example, if you were a Canadian corporation and it is a resident of Canada, you still had to file an underused housing tax if you had a property. Whereas this thing was always meant to be used for and even if you have a rental property that is being rented out in a corporation, you still have to file it. You have to file it to tell the government to exclude it, but you still had to file it. And if you didn't, there was penalties. So the key part of this program, it's changed a little bit now, but it's still not the best program administered right now. So basically, the bottom line is it's a 1% tax on the ownership of a vacant property, and it's based on the fair market value of that property. It's residential properties only. It excludes vacation properties and properties that are deemed commercial. So if you're I'll give you an example. We have one client that has rental properties in BC that are short-term rentals. That area is deemed commercial, so the underused housing tax will not apply to them for that reason, because that area and the units themselves are considered commercial units. If you are an affected owner, you have to file by April 30th of the following year. This is for individuals that are non-residents, for corporations incorporated outside of Canada, and partnerships or trusts that have foreign interests. And the key part is that it's based on your status as of December 31st of the calendar year. And the onerous on this tax or on this filing form is that each individual has to file a separate return for each property that it applies to. So if you have 3 or 4 properties that this would apply to you, you would have to file 4 separate returns. If you share it with a spouse or someone else, now we have 8 in that same example. And this one is based on who actually owns who's on title of the property, not anything else. So now let's talk about the sale of your principal residence. Anything received from the sale is 100% tax-free, which you already talked about, and that's one of the main reasons that it's so important to know your principal residence and its exemptions. This is a new thing. It's only about 10 years old now, where the government wants to keep track of when you sell your principal residence on your tax return. So you have to file it and declare that you sold a principal residence. Honestly, before 2016, this was not a requirement. And the concern that most Canadians have is that this is the government's way of first getting information about how much principal residences, how many are being sold and transacted on every year, because ultimately they'll start taking away that as a key piece as well. That's the concern. We're not there yet, but depending on how things go, it could always change. If you're a non-resident, you have withholding taxes that apply if you're a non-resident. So whenever you're selling a property, you'll notice that your lawyer will always ask you, are you a resident or non-resident of Canada? This is the reason why they ask it, because the CRA requires it requires the buyers, the onus is on the buyer, not the seller. It requires the buyer of a non-resident to withhold taxes on that sale. If they don't, the CRA will go after the buyer, not the seller. So what does this mean? Well, depending on how that property was used, it's either 25% of the sale price that is withheld or 50% of the sale price that is withheld and given to the CRA. What determines this is if it was ever used for rental purposes. So if you're a non-resident and you have a property, if it was never rented out, you would pay 25% of the sale price as the withholding tax, and then you would file with the CRA and the CRA would give it back. If you had used it for rental purposes, 50% has to be withheld on the sale price until you file your tax returns. So why? So I've had cases where clients were non-residents were renting out their properties and they were not declaring those rental incomes at all. And everything was fine. And they were doing this for about 10, 15 years. What they didn't realize is that when they want to sell it, withholding taxes will apply. So when the withholding tax applies, that's when the government's going to say, well, all right, you used it for rental. So 50% of the sale price, I'm going to hold off. Now, I'm going to hold that 50% until you file all those backdated taxes and declare all the income. So this person had to go back and through their numbers and come back with their 15 years of backdated rental income in their property. Then they would send it to the government. The CRA at that point would say, great, now because the first one was 15 years ago, I'm going to apply interest and penalties for 15 years. The next one was 14 years old. I'm going to apply interest and penalties for 14 years on the 14-year one, and 13 and 12. So you can imagine that the cost of this goes up significantly. So if you're a non-resident and you have rental properties, keep in mind that even if you're kind of not declaring right now, when you try to sell your property, that's when you're going to run into this. And that's why the CRA is not so concerned directly with your property, because they know when it comes to the sale point, they can get you at that point because there's a 50% withholding rate on the sale price. So $1 million property, if you sold it for $1 million, 500,000 would be withheld by the lawyer from the buyer side and given to the CRA. So there is.
Sorry to interrupt. So they withhold it until you do the tax return or someone does the tax return, and then they get a portion back.
Yes,
Correct?
but it's so the buyer. So how the buyer's lawyer would withhold it for 30 days, and then they'll say if you get it, what they call a clearance certificate from the CRA within that 30 days, then I'll release. Because in the clearance certificate, it'll say give this much to the seller and give the rest to me from the CRA's perspective. If it's more than 30 days, then the buyer's lawyer has to remit the entire in our example, $500,000 to the CRA, and then you have to deal with the CRA directly.
Okay. And it's just for non-residents. And they can't even buy in Canada right now anyway, so it's people who owned from before.
Yes, you'll hit this when you sell. And now there is a tax clearance certificate that's required that you can get, but quite honestly, the backlog with the CRA is about 6 months to a year. So unless you have a long closing date on your property, there is a chance you might get the clearance certificate before the close date, right? When it firms up between the firm date and the close date. But just last month, I had a client that their firm up the different like they firmed up and then they were closing in a month and they were non-resident. So I said that like there is no way in hell this year is going to get back to you with this clearance certificate. So for example, we had to end up filing the forms with the CRA, but right now the money was remitted to the CRA and we have to deal with the CRA directly because of their situation. So that's why I'm saying that there is a risk of backdated taxes, penalties, and interest at the point of sale on your rental properties at that point in time. So be very cautious with this thing. So that was a lot of content on a lot of tax stuff. Now I'm going to tell you a little bit about us. Um, so who are we? Well, we are trusted because our firm is registered with CPA Ontario. Um, we are specialized. Our expertise is in finance and accounting. Our team has over 70 years of combined experience. And we're focused because our firm deals exclusively with small businesses, investors, and individuals. So what do? We are cloud-based. We are focused on accounting firm, we're a cloud-based accounting firm based in Toronto, but our primary focus is all of Ontario. We have inclusive pricing that includes unlimited advisory services for small businesses. So, like, I encourage the people, our small business owners, to contact us because we're here to help them. We provide tax services, so bookkeeping, HST, income tax, payroll, estate planning, all that stuff we do. And finally, one of my favorite pictures, financial guides. We work with you to reach your goals faster on your investments and your personal budget. So we're here to really like our motto is your partners in growth. So that's what we want, your growth. So we want to work with you to get there. This is a little slide about why choosing an accountant. Um, in terms of compliance, we try to make sure that you stay within the laws and avoid any costly errors. Um, we are held as CPAs, we are held to a higher ethical standard. Um, our expertise is in taxes and bookkeeping and accounting and financial statements because we've spent years doing that. And we do provide, and that's just one part of it. The second part is that I work a lot with small business owners looking at their businesses in terms of where we can optimize, where they can save, where they can increase their revenues. So we work with them to see what makes their business work and what areas they can focus on um, to optimize their costs. So I like this quote a lot. Um, if you're proactive, you focus on preparing. If you're reactive, you focus on repairing. By John Maxwell. I didn't come up with this. But our goal is to focus on preparing you. And how we do that, we are accessible. Um, we are constantly in contact with our clients throughout the year. We're open 7 days a week. Our response time is typically 1 to 2 business days. So honestly, one of the things that I get a lot when people like come on our phone is that I can't even get a hold of my account. So we are proud of that. I'm very proud of that. We are insightful, so our clients have real-time access to reports that help them understand their businesses. Um, we give them actionable advice throughout the piece, and we do have virtual CFO services for clients that do need it. I am a big believer of transparency and being accountable. So our whole thing is built. We have a team, but I will be your point of contact for all things, good and bad. I'm the go-to person, but we do have a team and behind the scenes working to make sure everything is done right. Our clients have a direct access to what I call the read-only folder. And what I say is anything that we do for you, anything that you give us for that tax year, we put it all in that folder for you so that you know exactly what it is we filed for you, why we filed it, what was given to us, and also makes it so that if you need information later on, you can easily go to that folder and see exactly whatever it is that you need. I get a couple of times I have people that would say, "Oh, I need to know like what was my tax return for my mortgage." Not a problem. Just go into your read-only folder. It's all right there for you. And we don't complete anything without actual approval or sign off from you. And if it's something that you don't know, again, part of being transparent and accountable is I want to make sure you know what it is you sign and what you usually do. So I'm happy to go through that with you anytime. So I'm going to give you some closing remarks. If there's nothing else you saw from our presentation, I said these are the key things to consider and think about. First things that your residency status is very important for Canadian taxes. As we just saw with the non-resident, resident, how the taxes are done for those. Plus, if you're non-resident, you get extra goodies like the unused housing tax and non-resident speculation tax and so on. HST rebates are available for first-time home buyers for that are residents of Canada. Improvements or investments in your property are considered capital expenditures. So again, renovations, big renovations, roofs. You can't deduct the full amount in that year, but you can deduct it over time. Your principal residence it can be truly a powerhouse for your retirement, can be one of the ways that you can save a lot, but it is limited to 1.24 acres. And any gain from your sale is 100% tax free. And finally, don't forget about deemed dispositions or acquisitions whenever you have a change in use. And avoid the costly pitfalls by trying to go for the 4-year elections where you can. So that's the piece that I'm going to leave you with. So I'm going to say thank you for attending, but I'm going to leave it open for questions. But here's our contact information if you'd like to reach out or discuss anything in more directly related to yourself.
I have some questions. I don't know if anyone else wants to ask first, but you mentioned travel expenses can be claimed for investment properties.
Cannot be travel, yes, but not the meals and lodging.
Okay, so when you say travel, let's say someone has to go to an office to pick up checks. Does that count?
Yes. Yes.
Or checking on the property?
So if you have one property, no. If you have multiple properties, yes.
And then if someone has a work relocation to Toronto and they have a property here in Ottawa and they drive back to check on the property, does that count as travel?
If
No.
it's one, no.
Okay. And then you mentioned depreciation, like the cost of appliances. Let's say you bought the house with appliances. How do you account for the cost of appliances?
Well, you're supposed to separate it out if the house, like generally, whenever we have someone that gives us the details for their property, we split it out into land because we always have to know a portion for land. That's one. And then the
Oh,
appliance piece is going to be, we have to make an estimate for it. But generally, if it's like, even for capital expenditures, if it's under like $500, the CRA will say we'll just expense the whole thing, right? So it depends on how good that appliance is. If it's like a Sub-Zero stove or Wolf stove, then maybe there'll be some value for it versus like, I don't know, some lower one that's been around for a while.
okay. Or so like, let's say it's a $2,000 fridge that came with the house. How would you know how much to depreciate?
You have to make an estimate,
Okay.
reasonable estimate,
Okay.
right?
Okay, perfect. And then you mentioned that you do estate planning for taxes, and I think that would make a really good topic. Um, I know some people go to lawyers for estate planning, and I think there's a big difference between what a lawyer will do and what someone like yourself can do.
Yeah, the lawyers, so we never deal with any of the legal paperwork. So the lawyers deal with the paperwork in terms of like creating a trust, for example. The lawyers do all the trust work and all that part. What we do is we kind of work with you to see does it make sense to make a trust or not. So it's more they take care of the actual action of it, where we say does it make sense for you to do that action or not before you go there.
Right. And just to like further expand, I think most of us on the call here, we do have children. And at some point, we have to decide how we want to leave our assets basically to our children with the least tax implication. Because the worst thing, we work all our life and then the government takes half of what we have and gives half to our kids. So I think Ali, you might, if you're open to it, maybe we could do something on that too.
Yep. And actually, the capital gains rules that are proposed that the Liberal government just proposed, like 67% we just talked about, quite honestly, the idea that I think most people think that the government did that to tackle and get their hands on estate transfers
Oh,
because
that's
that's the big because for example, if you have a property, if you have multiple properties and you pass away, you gotta give it to your kids. Automatically, capital gains tax. First 250, 50%. Anything above that, 67%. Right.
that's
So
evil.
that's one of the that's the thing that people were very critical of the government because like they were saying that it applies to a small percentage of people. And it's not true because, well, not you might have a cottage. Not like you're not going to sell a cottage every single year. But then when you do sell that cottage, you're going to be hit by it.
Exactly. Okay, I don't know if anyone else has questions. That's it for my questions.
Oh, yep. Yes, Peter.
Can you hear me here?
Yes.
Yeah, so I have a question regarding the change in use. So maybe it's just because I'm not so good when it comes to like the technical terms of housing. However, if you could give like a numerical example, because let's say if you have a principal residence and a few months down the line, you want to, let's say, switch it to being a rental property. So let's assume maybe the property is worth like maybe 100K, let's say. So I'm just curious to know, like, these tax implications. Like, let's say this person files the taxes, like, because it's the principal residence and you're changing it to a rental property, and you say that's more like you are selling it, even though you're still owning it, but it's just like you're selling it because now it's gonna be a rental property. I just want to
Yep.
understand more the tax
Sure.
implication numerically. I mean, if you give an example of numbers, at least I can actually have a better understanding of
Yep.
like what it
So
really means.
think of it as okay, we're gonna say it without the election, right? Simple case, no
Mm,
election.
yeah.
If you bought the property for let's say 100,000, and let's use a little bit of a longer timeline because maybe in a couple of months it won't go up that much in value, so it will not matter. But let's say that in a year it goes up to 150. If you went and when it's at $150,000, you said, I want to make this a rental property. So because even though you didn't sell the property, there's a change in use. So the fair market value when that change in use happened would be 150,000. Because it was your principal residence from the point of 100 to 150, that's tax free. So in the eyes of the government, CRA, no taxes you got to pay at that point in time because the change in use happened, but it was always your principal residence, no tax on principal residence. So until 150, tax free, we're there. Let's say that you rented it out for 2 years and now the property is worth $250,000. So when you sell that property and now it's worth 250, you're going to pay capital gains tax from the difference of 250 from the 150. So in this example, you'd have to report capital gains tax of $100,000 on your tax return. Does that help,
Okay.
Peter?
Yeah, that helps. But yeah, so on the last point you just gave about where like you have to pay the capital gains tax on the 100,000, which is the difference, right? So it's
Yes.
more like is it the 50% of that 100K is
Under
gonna
current
be?
rules, yes.
Oh, okay. And
So so you had
yeah,
a
go ahead.
so you had in this example, 100,000 is capital gains. 50,000, half of that, 50,000 will go on your income. So you're going to report income of that. So you're going to say, hey, government, I made 50,000 added on my income. And then the other half, the other 50,000 is tax free.
Okay. Sorry, last question that I have. It is something to deal with the vacant unit tax. So recently, I actually received an email which was actually requiring me to like fill a form which is for vacant unit, and it says that if you don't file that form, it's more like you're gonna be subjected to a penalty. So like now, I was confused because I was like, okay, I have rented out the property anyways, and I am going to report the income when I file for the taxes. So then I was asking myself, like, yes, it's actually my principal residence, even though I don't live there. However, do I really need to actually file for that, even though I'm renting out the property? I don't know if you get my point.
Sorry, I'm not. I think we'll have to probably take that offline because I'm not sure what you mean with which
I
form you're
I
talking
think I think I know because if you don't fill out that form, if you whether or not it's occupied, rented, or your principal residence, if you don't fill it out, the municipal government, they will add 10% to your property tax. So, I mean, everyone here on the call, make sure you fill out your Ottawa vacant unit tax declaration,
about.
whether you live there or rented, or if you have several properties, you need to fill that out. Does that help?
Oh, okay, yeah, that helps. Yeah, because I was just confused because I was like, yeah, it's actually I bought as my principal residence. However, I don't live there, so it's more like
Everyone
a
needs to fill
tenant
that out.
lives.
Yes,
Yeah.
Okay, yeah, yeah. Thank you. Yeah.
that's actually a very good point. Yes, because like even Toronto has their own underused housing tax, for example, and all the other cities are getting them into it. We focus more on the CRA part of it because honestly, if you wanted to look at every single municipal city, it's going to be chaos. Yes, but thank you, Negin. Yes, there is the ones that are for Ottawa as well. I know actually I read about that in the news. It's very controversial. So yeah.
Actually, another question came to mind. You said that if you have a primary residence that you rent out, you have 4 years to declare it as your primary residence. So does that still count? Let's say you move to a different city and you're renting in a different city. Can you still claim that as your primary residence?
Yep. As long as
And
you
then,
make the election in the year that the change happens. Because if you do it anytime after that tax year, the CRA could deny it. It's up to them to accept it. If you do it in the year that happens, they have to accept
okay, perfect. Okay. I don't know if anyone else has any other questions.
it. I think Peter, do you have another question, Peter?
Oh, yes, I have another question. Yeah,
Yep.
back to Negin's point about the 4-year election. So now the thing is that so let's say if during those 4 years, maybe you were renting out the property. So now when you file for the taxes, are you allowed to deduct the property taxes?
Yes, you're definitely allowed to deduct your property taxes. The only thing that you cannot deduct is any fines from the city or any penalties like that. You cannot deduct those.
Mhm.
So any sort of penalty or fine from a government body, whether it's city, provincial, or federal, you cannot deduct those.
Okay, thanks.
No problem. Any other questions?
I have a question.
Yes, Ali?
Uh, Assuming I'm gonna buy a property and wanted to rent it out. So when I buy it,
Sorry, Ali, can you come closer to the, it's hard to hear you.
okay. So assume I want to buy a property and rent it out. When I buy it, it needs a lot of renovation,
Mm-hmm.
make it happen. So, for example, I spend $100,000 to upgrade the property and then I rent it out. How can I
Yeah.
claim this big amount?
Yeah, so that would be considered capital expenditure, for example. So, um, depending on what it is that you renovated or did, we would add that on to the cost of your property. So this is the more technical part of it, but if you buy a property and you have not rented it out yet, any expenses you have at that point in time gets added on to the purchase to your cost of your property. You can't claim capital cost until you start renting your property actually out. So normally, if you had 100,000, you buy your property for say 300,000, and you include all your expenses, lawyer, legal, whatever, it's 300,000, and you spend 100,000 for your renovations. So now the cost of that property is not 300, it's really 400. So when you sell it, you would be able to pay less capital gains tax at that point.
So whatever I expend during the renting period, I can claim it from the tax.
Yep. So while you're renting the property out, let me go back to that slide actually, maybe that'll be helpful. So this one. So while you're renting the property out, you would declare your income from the rental, and then you would have your expenses. So accounting fees, property taxes, mortgage interest, and tax return. So for example, if you had a change in use and you want to make the election for the 2024 tax year, for personal taxes, the deadline is April 30th. So you have to file that with your tax return by April 30th.
2025. Okay. All
Sorry,
right. Yeah. Okay. I think, yeah, that was the other. Yeah, I think that's it. Thank you so much.
No problem. Any other questions?
Thank you so much, Ali. Appreciate you taking the time to do this.
My pleasure. Feel free to reach out anytime. I hope everyone has a lovely evening.
Thank you so much.
Thank you.
Bye.
Thanks.